This startup raised over $40 million from top Silicon Valley investors. It was described as the next company that would change the market. But in a short time, one single management decision turned success into total failure and shut the company down forever. What's even worse, major companies made the exact same mistake and lost billions. Today's story is not about a bad idea, and it's not about a lack of funding. It's about one of the most common and dangerous mistakes in startups: expanding too fast before fixing the foundation. A mistake that looks smart on paper, but is deadly in reality. The company started with a simple, attractive idea: solve a daily problem that thousands of people deal with. Faster, cheaper, smarter than anything else on the market. The founder was a great speaker. He knew how to sell the vision. During early pitch meetings, investors were impressed, and in a short time, the company closed its first major funding round. Media attention followed, expectations skyrocketed, and pressure began to grow. With millions of dollars in the bank, the company moved extremely fast. New offices, dozens of new hires, massive marketing campaigns, big promises to investors. On paper, the numbers looked amazing: user growth, downloads, market expansion. But something critical was missing from those reports. Users started to complain, not loudly, but consistently. The product felt confusing, the service was unstable, customer support was slow, features nobody actually needed. Internal teams noticed the issues. The data clearly showed them. But management had one response every time: growth matters more. We'll fix it later. That's when the real damage began. Instead of slowing down to fix the product, leadership made a risky choice: expand faster. Much faster. Enter new markets, add more features, double spending. The belief was simple: scale will solve everything. Reality disagreed. As the company expanded, the problems expanded with it. Users began leaving, operating costs exploded, revenue couldn't keep up, investors started losing confidence, future funding rounds failed, then came budget cuts, layoffs, entire departments shutting down. Not long after, the company closed completely. This story may sound familiar because it happened to a real company: WeWork. WeWork wasn't small. It was once valued at $47 billion, but it made the same mistake: aggressive expansion, massive spending, ignoring core problems, overconfidence in leadership. Instead of building a clear, sustainable business model, the company focused on growth and image. The result? A dramatic collapse. Billions lost. Investor trust destroyed. The lesson is clear: size does not fix weak foundations. In 2019, one company was valued at nearly $47 billion, and many believed it would reshape the future of work worldwide. Yet within just a few years, that same company filed for bankruptcy and lost most of its value. How can a company grow this fast and collapse just as dramatically? The story of WeWork is not just the failure of a startup. It is one of the most important lessons in modern business. In 2010, WeWork launched with what seemed like a revolutionary idea: transforming traditional offices into flexible coworking spaces that combine modern design, community, and convenience, especially for startups and entrepreneurs. The concept quickly gained traction, and within a few years, WeWork became one of the most famous startups in the world. The period of rapid growth. Between 2014 and 2019, WeWork experienced extraordinary expansion, expanded to more than 100 cities worldwide, attracted massive investments, most notably from SoftBank. reached a valuation of approximately $47 billion. Revenues grew rapidly. 2016, about $436 million. 2017, more than $880 million. 2018, around $1.8 billion. However, despite this strong revenue growth, the company was reporting increasing losses year after year. The beginning of the decline. The core issue was the business model itself. WeWork signed long-term lease agreements with high fixed costs, while renting spaces to clients through short-term flexible contracts that could be cancelled easily. This mismatch created significant financial risk, especially during downturns. At the same time, the company expanded faster than it could control its operational costs, without ensuring profitability in existing locations. He failed IPO attempt. In 2019, when WeWork attempted to go public, its financial disclosures revealed massive ongoing losses, no clear path to profitability, governance and leadership concerns. Investor confidence dropped sharply, causing the company's valuation to collapse and the IPO effort to fail. The final blow, COVID-19. When the COVID-19 pandemic spread globally, demand for office spaces declined as remote work surged. Meanwhile, WeWork still had to meet its long-term lease obligations, which significantly increased its financial pressure and losses. In 2023, the company filed for bankruptcy protection and began restructuring, closing unprofitable locations and reducing debt. Today, WeWork continues to operate, but at a smaller scale and with a more conservative strategy. Key lessons from the WeWork case. Rapid growth does not equal success without profitability. An unbalanced business model may work temporarily, but collapses under stress. Expansion should be built on strong financial fundamentals, not expectations alone. Large funding rounds can delay failure, but they cannot prevent it. Strong governance and disciplined leadership are essential for long-term sustainability. The WeWork story proves that true success is not measured by company size, but by its ability to survive and sustain profitability.
If you're an entrepreneur or planning to build your own company, remember this story. Fast success can be a trap. And if you enjoyed this breakdown, subscribe for more real startup stories and business failures explained. Because understanding failure is the first step towards success.